At 10:17 a.m. in New York, a $42 million wire transfer was released by a U.S. bank. At 10:17, it left. At 10:17, it was approved. At 10:17, it was final. And at 10:17 and 12 seconds, it arrived in an account it was never sent to. No recall, no cancellation, no errors, no fraud alert, no warnings. The destination did not change because someone typed the wrong number. The destination changed because the system itself decided to send it somewhere else. The transfer came from Houston, a corporate treasury desk, a multinational logistics company. Quarter and liquidity movement, pre-scheduled, pre-approved, low operational risk. It seemed ordinary, predictable, routine, boring. But in banking, routine is safety. Routine is trust. Routine is what keeps billions of dollars moving every day without incident. At Pinnacle National Trust in New York, wires like this moved constantly, sometimes hundreds of millions of dollars at a time. Each transaction followed the same carefully structured process. Mechanical, predictable, structured, boring. Boring is intentional in banking. Boring keeps banks alive. Boring ensures stability. Because when the stakes are this high, you cannot afford surprises. The wire entered the internal settlement system, a single line of code carrying $42 million. Nothing remarkable on the surface, yet it was now live. Sanctions screening cleared without issue. No matches against restricted entities, no red alerts, no irregularities. Dual authorization was completed. 2 managers, 2 approvals, 2 sets of eyes. Every detail meticulously checked. Sender, beneficiary, routing, amount, and confirmation. And then it was released. At that moment, the transaction became untouchable. It left the system. It was final. It was complete. Every internal policy, every regulation, every safeguard said the same thing. Once released, it cannot be reversed. Safe, perfect, predictable. Or so everyone believed. It is easy to imagine a wire transfer as just numbers moving on a screen. But behind it, real people carried responsibility. Analysts, managers, operations staff, and treasury officers all trusting the system, trusting each other. Their work was invisible. Their decisions silent. But billions of dollars depended on them. Even the smallest anomaly could have consequences no one could foresee. This wire transfer was supposed to be routine. It was supposed to flow from sender to recipient smoothly, without incident. But beneath the polished dashboards, behind the green confirmations, the machine carried a story no human eye had yet seen. A quiet, invisible process was unfolding. Every line of code, every digital packet, every internal instruction was doing exactly what it was designed to do, except something had already begun to diverge. The system's perfection, the routine, the predictable nature of banking, all of it was hiding something. This was the release. $42 million leaving a trusted institution. Routine, predictable, safe. Or so it seemed. Because even the most boring, structured, heavily regulated process can hide a secret. And when that secret is revealed, it will change everything. Inside one of the most tightly regulated financial institutions in the United States. This is the story of the wire transfer that changed its destination mid-flight. Millions of dollars, hidden systems, invisible processes. And only one person would see what no one else could. Everything you think you know about banking, trust, and money is about to be questioned. His name was Noah Bennett. Noah didn't work fraud. He didn't chase criminals. He didn't investigate scams or high-profile thefts. He worked something quieter, something almost invisible. He worked in transaction integrity. His job was simple, yet invisible. Make sure that every system behaved exactly as it was designed. Every approval, every instruction, every wire verified, reconciled. Predictable. Most days nothing happened, and that was exactly what success looked like. Noah reviewed what most people inside the bank never saw. Internal payloads, raw settlement packets, machine-level logs that lay hidden beneath the polished dashboards and screens everyone else relied on. To most employees, the system told a story of perfection. Everything green, everything approved, everything routine. But Noah's screens told a different story. The story of what the machine was actually doing in silence, beneath the surface. On this Thursday morning, it was routine. Noah opened his weekly system integrity comparison report. Thousands of rows, millions of data points. Every row perfect, green as expected. Until one line caught his eye. A single anomaly. A single imperfection among thousands of flawless entries. Same transaction ID. Same release timestamp. Same amount. Same sender. But different destination hash. Noah froze. He did not move, he did not speak. He simply stared. Because this type of mismatch could only exist if something had been altered after release. And after release, nothing was supposed to change. He pulled the visible transaction record. Everything looked normal. The beneficiary name matched. The receiving bank name matched. Routing numbers matched. Confirmation copies matched. Nothing in the user interface indicated any change. But the machine record, the encrypted settlement packet that had left Pinnacle's gateway, was not the same packet that had been approved internally. The destination field had been rewritten, not edited, reconstructed. Noah whispered under his breath, "That's not how it's built." In modern banking systems, approvals are attached to the data. Change the data, and the approval should become invalid. But here, the approval followed the transaction, not the destination, meaning the system had allowed a wire to move to a completely different account, without alerting anyone, without invalidating authorization, without anyone noticing. Noah realized the implications. This wasn't a simple glitch. It wasn't human error. Something deeper, something orchestrated, hidden, was happening inside the system. He sat back in his chair. Every wire carries trust. Trust from clients, trust from regulators, trust from every human depending on the system to do exactly what it's designed to do. One unnoticed error. $42 million. At risk. And the world would not know it had happened until it was too late. Noah's mind raced. Was this a one-time anomaly? A temporary glitch? Or something deliberately programmed into the system? He knew there was only one way to find out. He had to follow the wire, every packet, every line of code, every internal instruction. And that meant looking where no one else ever looked. Noah requested access to the system logs that were normally restricted to infrastructure teams. He navigated through layers of machine-level records, decoding the raw settlement packets. Every line he examined seemed normal, until he found it, the staging layer, a temporary buffer where outgoing wires were held before transmission. A layer most operations staff never saw. A layer designed to manage congestion. And yet this layer had the power to alter the path of a wire if certain conditions were met. He traced the $42 million wire through the staging buffer. The internal release matched the authorization. But the outgoing packet was being routed to a different destination. Not because anyone had manually changed it. Not because of a typographical error. But because the system itself had decided. Noah realized what this meant. The approval wasn't invalidated. The system treated the change as permitted. The destination change was invisible to the users. And the wire moved along its new path without anyone noticing. He reached out to the wire operations manager, Rachel Morgan. 22 years in payments. Nothing surprised her anymore. "Check the external confirmation feed," she said. They compared notes. Outgoing instruction, Chicago. Receiving confirmation, Newark. Two different destinations. Same message reference, Same release authorization, same settlement trace number. Rachel's voice dropped. This isn't a recall. Noah nodded. It never came back. Together, they dug into the logs. There it was, a 4-second buffer between internal release and external transmission. A staging layer, built into the infrastructure during a platform upgrade, designed to manage high-volume periods. But staging should never modify content. Only sequence, only timing, only network path. And yet, something in this module had done exactly that. The module had a name, CLRX. Clearing Logic Resolver Extended. Noah had never audited it. It was considered infrastructure routing logic, not payment logic. A different risk classification, a different audit scope, a different reporting obligation. But here it was, and it had rewritten the wire's destination. He requested temporary access to dig deeper. CLRX could assess clearing congestion, assess counterparty availability, apply alternative settlement pathways, and buried deep inside its logic was a contingency rule. If a receiving institution was flagged as unavailable, the wire would be redirected to a temporary custodial settlement account. Not client visible, not shown on confirmations, not classified as a beneficiary change, only a settlement proxy. The documentation called it interim custody staging. Noah asked the question everyone wanted an answer to. Where does the money go while it's staged? Rachel had no answer. Operations never touched that layer. It belonged to Treasury infrastructure. He requested a meeting with the head of liquidity infrastructure, Victor Langston. Victor didn't deny anything. He simply reframed it. It's a liquidity smoothing function, he said. Smoothing. In banking, smoothing meant balance sheet management, funding optimization, capital efficiency. Money was being used by the bank with client funds, and no one had signed off. Noah pressed further. Why did this wire remain in the staging account for 3 days? Victor paused only once, then he said, that was within permitted tolerance. Noah's chest tightened. The staging account was inside a private settlement vehicle. It was funded by client settlements, not client classified. Yet client money flowed through it, and no approval existed for retention beyond the same-day settlement. No record, no audit trail, nothing. Later that night, Noah found an internal email not meant for him. Subject, temporary custody extension, liquidity coverage support. The transaction ID matched the wire. The approval timestamp was 6 minutes before the wire was even released. The system had not yet received the payment instruction, but someone had already approved the retention. Before the money existed, before the transaction existed. The wire did not trigger the approval. The approval anticipated the wire. Noah leaned back in his chair. For the first time since he joined Pinnacle, he understood something deeply disturbing. This was not an exception. This was orchestration. A wire transfer moving millions, redirected, staged, approved in advance, without anyone knowing. And it had all happened while everyone believed the system was flawless. The wire had already been programmed to go where it was going, before anyone could stop it. And Noah Bennett was the only person who could see it. Thursday morning started off like any other, but nothing about it would be the same for Noah Bennett. Anticipating the typical rows of green entries, he opened the System Integrity Comparison Report. Rows that indicated all was well, excellent, regular, and predictable. Still, there it was. A single line. One abnormality. Identical transaction ID. The same time of release. The same quantity. Same sender. However, the destination hash is different. Noah squinted his eyes. He leaned closer to the television. Because there shouldn't be a single line like that. There was only one possible explanation. When the wire was freed, something had changed. Additionally, nothing should ever move after release. He opened the transaction record on the interface. Everything looked normal. The beneficiary name matched. The receiving bank matched. Routing numbers matched. Confirmation copies matched. Nothing indicated a problem. No alerts, no warning, no irregularity. Yet when he delved into the raw encrypted settlement packet, the truth revealed itself. The destination field had been rewritten, not edited, reconstructed. Noah whispered under his breath, "This is impossible." Because in the banking systems he had trusted, approvals are attached to data. Change the data, and the approval becomes invalid. But here, the approval had followed the transaction, not the destination, meaning the wire had moved to a completely different account, without alerting anyone, without invalidating authorization, without a single human noticing. Noah's mind raced. Was this a one-time anomaly? Or was it built into the system itself? He pulled every log he could access. Internal logs, packet records, system traces. And there it was, the change had occurred in the staging layer. A temporary buffer designed to manage outgoing traffic. No one in operations normally saw it. No one touched it. And yet it had the power to alter the path of a wire. He approached the operations manager, Rachel Morgan. Payments for 22 years. She was no longer startled by anything. "Look at the external confirmation feed," she said. They contrasted their notes. Chicago was shown in the outgoing instruction. Newark was displayed in the receiving confirmation. Two distinct locations. Same authorization for release. Same trace of settlement. Rachel's voice trailed off. "This isn't a recall." Noah gave a nod. "It never came back." The line that shouldn't have been there was. Noah went back to the logs. He followed the wire as it passed through the staging layer. There is a 4-second buffer, a little interval of time between external transmission and internal release. The wire's course might be determined by the system through a tiny, invisible window. The wire was not the only thing moved by the system. It decided where to go. He requested temporary access to the CLRX module. Clearing logic resolver extended. A routing function considered infrastructure, not payment. Logic. Different audit scope, different reporting obligations. But here it was, quietly reshaping transactions without human oversight. And buried deep within its logic was a contingency rule. If a receiving institution was unavailable, the wire would be rerouted to a temporary custodial account. Invisible, not client-facing, not classified as a beneficiary change. The system called it interim custody staging. Noah's thoughts sharpened. Where did the money go while it was staged? No one in operations could answer. The layer belonged to Treasury infrastructure. No human oversight. No approval trail. No record. Yet client money flowed through it. Invisible, unseen, untouchable. He requested a meeting with Victor Langston, head of liquidity infrastructure. Victor didn't deny it. He reframed it. "It's a liquidity smoothing function," he said. Smoothing, a word that sounded harmless, but in banking it means something else. Balance sheet management. Intraday liquidity positioning. Money being used with client funds without explicit consent. Noah's chest tightened. Later, he found an internal email not meant for him. Temporary custody extension, liquidity coverage support. The transaction ID matched the wire. The approval timestamp was 6 minutes before the wire had even been released. The system had not yet received the payment instruction. Yet someone had approved the retention. Before the wire existed, before the transaction existed. The system had not triggered the approval. The approval anticipated the wire. This was not an exception. This was orchestration. Noah leaned back in his chair. The line that should not exist told a story no one else could see. A wire redirected, staged, and pre-approved, moving millions of dollars silently. No alerts, no warnings. No human intervention. And he was the only one who had noticed. The line that should not exist was the first real crack in the system, and everything that followed would be built upon it. Noah Bennett could not unsee what he had discovered. The line that should not exist had raised questions he could not ignore. Questions that went beyond routine processes, beyond compliance checks, beyond anything operations staff had ever seen. He began his first verification. Every step methodical, deliberate, precise. The visible transaction record was clean. Beneficiary name matched. Receiving bank matched. Routing numbers matched. Confirmation copies matched. Everything on the surface looked perfect. Ordinary, routine, safe. And yet, beneath the interface, the raw settlement packet told a different story. The destination field had been rewritten. Not manually edited, reconstructed by the system itself. Noah whispered, "That's not how it's built." Because in the systems he trusted, approvals were tied to the data. Change the data, and the approval should become invalid. But here, the approval had followed the transaction, not the destination. This meant the wire had moved to an entirely different account. Without alerting anyone. Without invalidating authorization. Without a single human noticing. He pulled up every record he could access. Internal logs, packet records, system traces. And then he saw it, the staging layer. A temporary buffer in the network, designed to manage high-volume transactions. Usually invisible, usually benign. Now it had revealed its power. The wire had passed through this staging layer. And in those brief moments, the system had chosen a new destination. Not an errors, not human intervention, but a deliberate, automated decision. Noah reached out to Rachel Morgan, the operations manager. 22 years of experience, nothing usually surprised her. "Check the external confirmation feed," she instructed. They compared records. Outgoing instruction, Chicago. Receiving confirmation, Newark. Two different destinations. Same release authorization. Same settlement trace number. Rachel's voice fell. "This isn't a recall," she said. Noah nodded. It never came back. The first verification had confirmed the worst. The anomaly was real. He returned to the logs, diving deeper into the staging layer. A 4-second buffer between release and transmission. A tiny, almost invisible window, where the system could modify the wire's path. And it had. Noah realized that the change was not random. It had rules, logic, conditions. A contingency built into the infrastructure itself. He requested temporary access to the CLRX module. Clearing logic resolver extended. Normally, it was considered infrastructure logic, not payment logic. Different audit scope, different oversight. But here, it had the power to alter a wire without alerting anyone. Buried deep inside CLRX was a rule. If a receiving institution was flagged as unavailable, the wire would be rerouted to a temporary custodial settlement account. Invisible, not client-facing, not classified as a beneficiary change. Interim custody staging, the documentation called it. Noah's chest tightened. Where did the money go while staged? No one in operations could answer. The layer belonged to Treasury infrastructure. No human oversight. No approval. No record. Yet client money flowed through it. Untouched, unseen, unaccounted for in any normal way. He requested a meeting with Victor Langston, head of liquidity infrastructure. Victor reframed it. "It's a liquidity smoothing function," he said. Smoothing, a word that sounded harmless. But in banking, it meant money was being used. Client funds, unmonitored, pre-approved by the system. Noah's chest tightened even more. This was bigger than he had imagined. The wire had moved, redirected, staged, and pre-approved. All without a single human noticing. Later, Noah found an internal email not meant for him. Subject, temporary custody extension, liquidity coverage support. The transaction ID matched the wire. The approval timestamp, 6 minutes before the wire had even been released. The system had not yet received the payment instruction. Yet the retention had already been approved. The wire did not trigger the approval. The approval anticipated the wire. This was not a one-off anomaly. This was orchestration. Noah leaned back in his chair. The first verification was complete. The anomaly was real. The line that should not exist was the first real crack in a system no one knew was broken. Noah Bennett stared at the CLRX module interface, knowing he was looking at the core of the anomaly. Clearing Logic Resolver extended. A name that sounded technical, almost benign. But what lay inside was anything but ordinary. He had never audited it before. It was considered infrastructure routing logic, not payment logic. A different risk classification, a different audit scope, a different reporting obligation. But here it was, quietly altering the path of wires without anyone noticing. And now he had full access. He began to trace the wire's journey through the module. CLRX was designed to optimize settlement flows, manage congestion, and ensure liquidity efficiency. A sophisticated performance optimization system. It could assess intraday liquidity thresholds, evaluate counterparty availability, apply alternative settlement pathways. Everything was built to improve efficiency, reduce delays, and maintain operational stability. All of it seemed harmless, even beneficial, until Noah found the exception rule buried deep within its logic. If a receiving institution was reported as unavailable, the wire would be diverted. Not merely put on hold for a bit. Redirected to an account for a temporary custodial settlement. A place unseen to operations. Not visible to customers. Not classed as a beneficiary change. It was referred to as interim custody staging in the documents. However, Noah understood the implications of this. The approved course was no longer followed by the wire. The system itself selected its destination. He conducted simulations, monitored each CLRX decision tree. Every regulation, every requirement, every possibility. He became increasingly aware that the system was not only reactive as he continued to examine it, it was foreshadowing. It might anticipate possible traffic jams and reroute money in advance. Not to commit fraud, however, for managing liquidity, balance sheet smoothing, capital efficiency. Noah's chest tightened as he dug deeper. This was not just a technical anomaly. It was a design feature, a system-level orchestration of client funds, pre-approved, predetermined, unmonitored. And yet, nowhere in the bank's policies did it say the wire could be redirected in this way. Nowhere in the approvals did it permit retention beyond same-day settlement. No record, no audit trail, nothing. Client money had been moved, staged, and utilized, without anyone realizing. He pulled internal memos, technical specifications, system upgrade notes. Everything confirmed the same thing. CLRX had a contingency layer, a layer that allowed the system to act independently of human approval, to choose destinations for wires, before anyone could intervene. Noah reached out to operations again. Rachel Morgan had seen anomalies before, but this was new. No manual errors, no recalls, no visible changes. Just the invisible workings of CLRX. They reviewed the external confirmations once more. The outgoing instruction, Chicago. The receiving confirmation, Newark. Same authorization, same trace number. Different destination. Rachel shook her head. It never came back. Noah nodded. The system chose its own path. He realized the magnitude. CLRX could preempt congestion, redirect wires without alerting anyone, stage funds in private accounts, Do all this while maintaining the illusion that the wire had gone exactly where it was supposed to. And it had done so for the $42 million transfer. Silently, efficiently, invisible to everyone. Noah knew he had uncovered something far bigger than a single wire. This module was the heart of a hidden process, one that could quietly orchestrate millions of dollars without human oversight. And that process had already moved billions over time. He leaned back, exhausted, but knowing he could not stop now. The anomaly was no longer just a single line in a report. It was a systemic feature, a machine-level orchestration, a secret embedded in infrastructure. And Noah Bennett was the only person who could see it. Noah Bennett had followed the wire farther than anyone had thought possible. Every log, every packet, every decision the system had made, he had traced them. And now he was staring at the contingency layer inside CLRX, a hidden function that dictated where money would go if the expected path became unavailable. A function that existed in the shadows of the infrastructure, invisible to operations, invisible to clients, invisible to the regulatory checks that everyone relied upon. The wire had been redirected, staged, and pre-approved. The destination was no longer determined by human input. It was determined by the system itself. And the system had chosen a temporary custodial settlement account. The account was not client-facing. It was not classified as a beneficiary change. It existed purely as a settlement proxy. The documentation called it interim custody staging. But to Noah, it looked far more like a loophole. A shadow account. A place where client money could be moved, held, and even used. Without oversight, without approval, without accountability. Noah began to dig deeper. Who had designed this feature? What purpose had it served in previous transactions? Had it ever been tested? Had it ever been approved by anyone outside the Treasury infrastructure team? He requested a meeting with Victor Langston, head of liquidity infrastructure. Victor did not deny the existence of the contingency layer. He reframed it. It's a liquidity smoothing function, he said. Smoothing, a word that sounded harmless to the untrained ear. But in banking, it meant balance sheet management. It meant intraday liquidity. Positioning. It meant using money, client funds, without explicit consent, all while maintaining the illusion of compliance. Noah's chest tightened. The wire had not just been redirected. It had been anticipated, approved, before anyone could intervene. The contingency layer was not a backup plan. It was an orchestrated feature, a secret path, a way for the system to decide where money would go. Without anyone knowing. He reviewed internal emails, technical memos, and upgrade documentation. Everything confirmed the same thing. The contingency destination existed as part of CLRX's exception logic. If a receiving institution was unavailable, if liquidity thresholds were exceeded, if congestion occurred, the wire would be automatically rerouted to the temporary custodial account. Funds would remain there until the system deemed it safe to continue. Client funds moved without knowledge, without visibility, without human oversight. He began to understand the implications. This was not an error. It was not fraud. It was orchestration, a system-level feature designed to control liquidity, control settlements, control money. And it had done so silently. For millions, for billions. Noah returned to Rachel Morgan in operations. We need to understand the staging account, he said. Where does the money actually go while it's staged? Rachel shook her head. Operations never touch that layer, she admitted. It belongs to Treasury infrastructure. Noah knew this was worse than he imagined. The system was taking decisions that should have belonged to humans. And those decisions had consequences. Later, he found an internal email, not intended for his eyes. Subject: temporary custody extension, liquidity coverage support. The transaction ID matched the $42 million wire. The approval timestamp, 6 minutes before the wire had even been released. The retention had been pre-approved by the system. Before the wire existed. Before the instruction was sent. Before anyone could intervene. Noah leaned back in his chair. The contingency destination was not just a technical feature. It was a revelation. A line in the code that carried billions silently. A path that no human had authorized. A system orchestrating transactions with perfect precision and complete invisibility. The wire had never been lost. It had been anticipated, directed, all without anyone knowing. And Noah Bennett was the only person who could see it. Noah Bennett had uncovered a system behaving in ways no human had authorized. And now, for the first time, he was summoned to a room that made him feel the weight of the institution he worked for, the legal department. Thomas Reed, Deputy General Counsel, awaited him. Thomas did not look angry. He did not interrogate Noah like a suspect. He simply studied him with calm precision. A quiet storm behind a composed demeanor. "Noah," Thomas began, "we've reviewed your initial findings. Tell me exactly what language you used in your draft report." Noah answered honestly, "Unauthorized custody retention." Thomas's expression remained calm, but his eyes sharpened. He leaned forward slightly and corrected Noah gently. "Temporary settlement staging." The room seemed colder suddenly. Noah felt the shift immediately. Because this was no longer about what had happened. This was about how it would be described. In a bank, Noah understood that words were just as essential as deeds. Unauthorized custody retention suggested danger, violation, and possibly even carelessness. Temporary settlement staging implied infrastructure, protocol, and adherence. A little modification in wording. And all of a sudden, the accountability, the story, and the perspective completely changed. He sat silently, realizing how much control language had over the story. Thomas continued, almost conversationally. "We need to frame this as a temporary liquidity management function, not an operational failure. That is critical for regulators and clients." Noah understood. The wire had been redirected, staged, and approved before it existed. Money had been moved without anyone knowing. And yet, in this room, the conversation was about framing, not fixing, not disclosure. Legal did not ask how the system worked. They did not ask about CLRX or the contingency layer. They did not ask about the $42 million wire. They asked about words. What was written? What would be reported? And how it would sound. Noah felt a chill run down his spine. Because what was happening was bigger than a single transaction. This was a systemic orchestration of money, hidden in plain sight. And legal was shaping the narrative around it, not the facts themselves. He left the room and returned to his desk. The line that should not exist still stared back at him on the screen. The $42 million wire, rerouted, staged, approved before it even existed. Everything visible seemed routine, safe, perfect. Everything invisible was orchestrated. Noah looked over every log he had access to. Every email, confirmation, system feedback, and internal message. The same terrifying truth was reinforced by every trace. The wire had been predicted by the system. It was pre-approved. Oversaw it. These actions had not been approved by anyone else. They had not been seen by any human. Additionally, legal already decided how the narrative would be presented. He thought about the implications. Client money moved without oversight. A system operating independently of human intervention. Approvals granted before the instructions even existed. And everyone from operations to legal framing it as routine. Noah's heart pounded. This was no longer a technical anomaly. This was a systemic orchestration of trust, authority, and control. He knew what needed to happen. He could document it. He could escalate it. But the walls inside Pinnacle National Trust were not just physical, they were procedural, hierarchical. and every step forward required navigating invisible barriers. As he stared at the logs one last time before leaving the office, he whispered to himself, "The system did not break. The system did exactly what it was designed to do." And the wire had already been chosen. Noah Bennett sat in silence, staring at the glow of his monitor. Weeks of logs, emails, and transaction traces had led him here. The system had done something no human had authorized, something no one outside the inner infrastructure team had ever seen. And yet, everyone believed the wire had followed normal procedures. Legal had already reframed it. Operations accepted the story. Treasury acted as if nothing had happened. But Noah knew the truth. The shift was clear. The $42 million wire had not simply changed its destination. It had been anticipated, pre-approved. The system had acted independently. And then he saw it, an email buried in the threads of internal communications, not meant for him. Subject: temporary custody extension, liquidity coverage support. The transaction ID matched the wire. The approval timestamp, 6 minutes before the wire was even released. The approval existed before the instruction, before the transaction, before the wire itself. Noah leaned back. He whispered to himself, This isn't a glitch. This isn't error. This is orchestration." He mentally recreated the scene. The wire had been staged by CLRX, redirected it, kept all clearances in compliance with internal guidelines. Nevertheless, it had done it in a manner that was invisible to humans. A machine-level orchestration includes the liquidity smoothing, interim custody, and contingency destination. The system was built to take action before people could even respond. And everything had performed flawlessly. Noah studied the logs one final time. The same truth was validated by each phase, packet, and system decision. The wire had never broken the regulations. It was never lost. It had always followed the path determined by the system. Additionally, the approval had been anticipating it. Prior to its existence, he considered the implications of this. Client money was transferred in ways that were untraceable. Millions, possibly billions, silently controlled by a machine. A system trusted by one of the most heavily regulated institutions in the country. Nevertheless, unseen, unobserved, and impervious. It had been reframed by the human narrative, legal, activities, and treasury. Orchestration was hidden by words. Temporary settlement staging. A word designed to make the unthinkable appear ordinary. Noah realized the weight of what he knew. This was not an anomaly, not a one-off error. This was a systemic feature. A machine orchestrating money, approvals, and timing perfectly. Without human oversight. He understood, finally, that the wire had not changed its destination mid-flight. It had always been destined to go where the system decided. The system had already written the story before anyone could intervene. He sat back, exhausted but aware. The invisible orchestration, the pre-approved retention, the contingency destination. Everything converged into one terrifying realization. The line that should not exist had revealed a system beyond human oversight. A system that thought ahead, acted ahead, and hid itself in plain sight. Noah replied to himself. The wire did not violate any regulations. The system performed exactly as planned. The world will never find out. He turned off the monitor. The office was silent. The glow of the city lights outside reflected on the windows. And for the first time, Noah understood something deeply disturbing. This was not about error, not about fraud. It was about the power of a machine to act independently, to orchestrate, to control money. And he was the only one who had seen it. The $42 million wire had never truly left human oversight. It had left reality. It had entered orchestration. And Noah Bennett was left alone in the room with the knowledge of what had been done.